Welcome to the Deep Dive. Today, we're diving into the world of electric vehicles. Specifically, we're taking a good look at Li Auto.
That's right.
We'll be looking at their 2024 performance, their strategies, and really what their latest annual report tells us about where they might be headed.
Mm.
Think of this as, your quick guide to understanding what's actually going on with this major player in China's, well, booming new energy vehicle market.
Yeah, it's a key source, that annual report, the Form 20F filing. It's packed with details on their operations and financials.
Right, so we'll break down their business segments, get a clearer picture of their financial health, figure out how they plan to deliver shareholder value, and just sort of get a solid sense of their direction.
And it helps to keep their mission in mind. Create a mobile home, create happiness. You really see that reflected in their focus on safe, convenient, comfortable family vehicles.
They've definitely built a reputation on that. They first made waves with their extended range electric vehicles, the ERUs.
Yep, the Leoin initially, and now the whole L series, L9, L8, L7, and the newer L6. Very successful.
But 2024 was a bit of a pivot, wasn't it? They made a big move.
It really was. They officially stepped into the battery electric vehicle, the BEV market. They launched the Li Mega in March 2024.
The Li Mega.
Yeah, it's this high-tech kind of flagship family MPV. And it signals this really interesting dual technology strategy they're pursuing now.
Dual strategy. So they're not ditching the ERVs.
No, not at all. They're sticking with ERVs where they've had a lot of success, but now they're also developing and selling these pure BEVs right alongside them. It's a parallel path.
Okay, that makes sense. They were pioneers in ERVs in China, right? So why the big push into BEVs now? What's the strategic thinking?
Well, what's really interesting is how they're entering the BEV market. They're focusing on what they call HPC BEVs, high-power charging battery electric vehicles.
Like HPC high power charging.
Exactly. And to make that actually work well for customers, they've sunk a lot of investment into building out their own high-power charging network.
Their own network. Wow.
Yeah. By the end of 2024, they already had, 1,727 supercharging stations up and running. That's over 9,100 charging stalls across China.
That's a significant number already.
It is. It's a bold move, really. It suggests they're not just testing the waters with BEVs, they're trying to tackle charging anxiety head-on by controlling that infrastructure.
So potentially a big competitive advantage, a smoother experience maybe.
That seems to be the goal. Offer something more integrated that others might struggle to match. But, it's expensive and there are risks. Logistics, user adoption, it's not easy.
Beyond the powertrain, another big part of their appeal seems to be these smart space features. What does that actually mean day to day?
Right. This is all about the in-car experience, making you feel like that mobile home. Their Lyle series and the new Li Mega have these pretty sophisticated systems.
Like what, specifically?
Think multi-screen interactions, advanced voice controls that do more than just basic stuff, and crucially, continuous software updates OTA over the air that add new features over time.
Ah, so the car keeps getting better.
That's the idea. Seamlessly moving content between screens, using voice for complex things, just making it more comfortable and convenient, especially for families.
And how do they build these increasingly complex vehicles? What's their manufacturing approach?
They've gone for in-house manufacturing, primarily. They have bases in Changzhou and Beijing.
Okay.
And that close link between engineering and production, well, it allows for tighter quality control, quicker fixes, faster improvements,
Makes sense.
Though they also, of course, partner with leading suppliers for certain key components. It's a mix.
And all this innovation, the new models, the software, it must require a massive R&D effort, right?
Oh, absolutely. R&D is critical in the NEV space. It's moving so fast.
Yeah.
Like Auto knows they need to keep innovating, upgrading existing models, bringing out new ones with the latest tech just to keep up.
So the R&D spend isn't just on batteries and motors?
No, it's broader. It's fueling those smart space features we talked about. The autonomous driving tech, the underlying systems for their charging network too. But like any big R&D effort, there are risks. Not every project pans out right.
True. And with more models, different powertrains, this expanding charging network, does inventory management become a headache?
That's a really sharp point. Yeah, as the lineup grows, managing inventory, effectively having the right cars in the right place without tying up too much cash or risking write-downs, that's definitely a growing challenge for them.
And they're doing all this in maybe the most competitive NEV market globally.
Intensely competitive, yes. The report is quite upfront about that. They face pressure from established players, other startups, and there's always the potential, however small maybe, for disruption from new tech breakthroughs elsewhere, or even theoretically improvements in traditional engines. though that seems less likely now.
Looking ahead, the report mentions possible international expansion. That sounds like a whole different ballgame, especially now.
Definitely adds layers of complexity. You've got different competitors, different consumer tastes, uh, regulatory hurdles, and of course, protectionism and tariffs.
Right. The report mentions increased tariffs on Chinese EVs in the US and EU for 2024, 2025.
Exactly. And while Li Auto doesn't currently sell in those regions, those kinds of trade barriers in major markets could still, impact their broader long-term thinking. Plus, going international just requires a huge amount of capital up front.
It's not just market competition, then. The regulatory side within China sounds pretty complex, too.
It really is. So the report goes into quite a bit of detail. Cybersecurity and data privacy are huge ones. You've got the PRC Civil Code, the cybersecurity law, personal information protection law, strict rules on handling data.
Which means constant investment in security.
Yes, and potentially having to adapt how they operate to stay compliant. That's a big ongoing cost and focus.
And then there's autonomous driving, which also has its own set of evolving rules.
Absolutely. There are specific circulars and notices governing road testing and the eventual deployment of intelligent connected vehicles. It's a moving target.
Okay. The report also flags foreign investment rules and this variable interest entity structure, the VIE structure. Why is that a risk?
The VIE. It's a common setup for Chinese companies in restricted sectors, like aspects of telecom or internet services potentially tied to connected cars who want to list overseas.
So that's a workaround.
Essentially, yes, it uses contracts to give foreign investors economic exposure rather than direct ownership. But the whole structure relies on these contracts being upheld under PRC law.
And the risk is that the government could change its stance.
That's the inherent uncertainty. If the government deemed these arrangements non-compliant, it could seriously impact their control, their ability to move funds. It's a significant underlying risk. The report notes about RMB 20.1 billion of their net assets were tied up in these VIEs at the end of 2024.
Wow. And new overseas listing rules from the CSRC add another complication.
Potentially, yes. It might not affect their current U.S. and Hong Kong listings right away, but future fundraising, given the VIE structure, could trigger new filing requirements with the Chinese regulator. Not getting those approvals could hinder access to capital.
It's also mentioned they're a controlled company under NASDAQ rules because the founder, Mr. Sheng Li, has majority voting power. What does that mean practically?
It means they're exempt from certain standard corporate governance rules, like needing a majority of independent directors on the board.
So less independent oversight.
Potentially, yes. It gives management more flexibility, but it does reduce some of the checks and balances usually in place for minority shareholders.
Okay. And just quickly, before financials, intellectual property, and potential acquisitions.
They mention a large patent portfolio in China, which is obviously key in this tech-heavy industry. But, patents aren't foolproof. Applications might fail. Existing ones can be challenged. And acquisitions, while maybe a way to grow or get new tech, they come with integration challenges, costs, potential hidden problems. It's not always straightforward.
Got it. That really paints a picture of the operating environment. Okay, let's switch gears to the financials for 2024. Net income was RMB 8.0 billion. That sounds pretty healthy.
It is a strong number, yeah. Driven primarily by strong vehicle sales.
Yeah.
The Li L series really hitting its stride.
And how do they book that revenue? Is it just the car price?
No, it's more complex. When they sell a car, the revenue covers multiple things. The vehicle itself, yes, but also potentially charging stall installation, internet connection services, those over-the-air software updates, maybe Line Plus memberships, extended warranties.
Oh, so multiple components.
Exactly. And some revenue is recognized upfront, like for the car, while other parts, like subscriptions or warranties, are recognized over the service period. Good cost management likely helped that bottom line too.
What about the big expense lines?
Well, cost of sales is the big one making the cars. Materials, factory overhead, labor, and importantly, estimated warranty costs are baked in there.
Okay.
Then operating expenses. Selling and marketing was reported at about RMB 1.58 billion. That's advertising, running the stores, sales team salaries, things like that. And then you'd have G&A, general administrative costs, and of course that significant R&D spend we discussed.
Let's talk cash flow. Net cash from operations was RMB 15.9 billion. Very strong. How did that happen?
Yeah, that's a good flow. The key is looking beyond just net income. You have non-cash items that affect profit, but not cash. Think depreciation, share-based compensation expenses, inventory write-downs.
Accounting adjustments.
Exactly. plus changes in working capital. For instance, if their payables money owed to suppliers went up, that's a source of cash in the short term.
Uh-huh.
Same if accrued warranty provisions increased. On the flip side, building up more inventory uses cash. It's the combination of net income, those non-cash items, and the working capital swing.
And their cash pile at the end of the year.
They finished 2024 with RMB 65.9 billion in cash equivalents, and restricted cash.
Still a lot, though, less than the start of the year.
Yeah, it was down from RMB 91.3 billion at the start of 2024. But look, 65.9 billion is still a very strong cash position. It gives them a lot of flexibility for investments, weathering competition. The decrease reflects that spending on things like the charging network and R&D.
Looking at the balance sheet, you mentioned inventory went up, payables went up, and accrued warranty went up quite a bit. What does that signal?
Okay, so the inventory increase, about RMB 3.1 billion, likely reflects the broader product range and maybe building stock for expected sales. The payable increase, RMB 2.2 billion, could mean they're getting better payment terms from suppliers, which helps their cash management.
And the warranty increase, that was large, to over RMB 5 billion.
Yeah, RMB 5.16 billion. That suggests they're estimating higher future warranty claim costs. Could be due to selling more cars, new models having unknown factors, or maybe just updating their estimates based on experience. They also had about RMB 6 billion in short-term investments.
And the report states management believes their internal controls over financial reporting were effective. Why does it matter?
It's crucial for trust. Effective controls mean investors can have more confidence that the financial numbers are accurate and reliable, free from major errors.
Right.
Having both management and the independent auditor sign off on that is definitely a positive governance signal.
Okay, so solid financials, but with complexities. Now, how about creating shareholder value? Dividends, buybacks, what's the plan?
Well, on dividends, it's complicated by their structure. Liker Auto Inc., the listed company, is a holding company. It needs dividends from its Chinese subsidiaries to pay its own.
And those subsidiaries face restrictions.
Yes, PRC rules require them to set aside profits into statutory reserve funds, first at least 10% until the fund hits 50% of registered capital. They can also create discretionary funds. This limits cash available for dividends.
So, have they paid any dividends yet?
No, the report says the PRC subsidiaries haven't paid any dividends to the holding company to date. Plus, any dividends sent offshore would face Chinese withholding tax, maybe 10%, potentially 5% via Hong Kong under treaty conditions. But right now, their stated plan is just to reinvest earnings back into the business in China.
And share buybacks. Any mention?
The report doesn't mention any current or planned buyback programs.
Okay, so reinvestment is the focus. What about share-based compensation? Does that affect shareholders?
It can, mainly through potential dilution. They have active share plans from 2019 and 2020. As of early 2025, there were quite a few outstanding options in RSUs.
How do they handle those?
They use treasury shares they've previously bought back or held to satisfy option exercises and RSU vesting. They held about 63 million shares in treasury for this at the end of 2024. There's also still unrecognized compensation expense tied to these, about US $19.4 million that will hit the income statement over time.
And potential for future dilution.
The board does have the authority to issue preferred shares, which could dilute the voting power of existing ordinary shareholders. Although being listed in Hong Kong now adds some constraints from those listing rules.
All right, so pulling all this together, the strategy, the risks, the financials, the shareholder value angle, what's your overall assessment looking forward?
Well, there are definitely strong growth drivers. Expanding the product line, pushing forward with smart tech, building out that unique charging network. These are all positive signals. And that big cash cushion, that's a major advantage in this tough market. It lets them fund these big bets.
But as we've definitely covered, it's not without significant hurdles.
Absolutely not. Intense competition, the speed of tech change, the complex and shifting regulations in China and maybe abroad, geopolitical risks impacting supply chains, the whole VIE structure, uncertainty. These are all very real risks they have to manage constantly.
And we should remember the forward-looking statements disclaimer, too.
Always. What's planned or expected isn't guaranteed. Actual results could look quite different.
Okay, so wrapping this up, key takeaways for listeners from this deep dive into Li Auto's 2024 report.
I'd say, 1, they have a clear dual-track strategy, ERV and BEV, in a very dynamic market. 2, 2024 showed strong financial results, particularly profit and operating cash flow, fueled by sales success. 3, they're investing heavily in future growth, especially charging and R&D. 4, however, they face significant regulatory, competitive, and structural risks. And 5, returning cash to shareholders isn't the immediate priority. Reinvestment is partly due to PRC rules.
And maybe a final thought for people to chew on. Given how fast the NEV world is changing and all the complexities of operating in China and maybe expanding elsewhere, can Li Auto keep up this growth pace? Can they navigate all these challenges effectively to really cement themselves as a top-tier premium smart EV maker long term?
That really is the multi-billion-dollar question, isn't it? If you want to get even more granular, definitely check out the full Li Auto annual report itself. There's a lot more detail in there to explore.